Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. All right, welcome back. What's going on, Paul? How you been, man?
Good. Coming off the long weekend, and fall is here. It's in the 40s in the morning. I always talk about the weather. I feel like an old man, but
That's a real conversation here, though. I think I've said that before too. In
yeah,
Minnesota.
no doubt.
Weather's a real. Yeah, it's beautiful, man. It's in the 50s. Fall officially hit.
Good football weather.
I was out this weekend cleaning some windows. I've got these. I wanted to be outside because it was beautiful, and I wanted to do something productive. So I decided to clean some windows. We got these really tall windows on our main level, which is like on the second story from the backyard because it's a walkout basement.
Yeah.
So I had to get the ladder up against the house and then get this really long squeegee pole and go all the way up, and then use the squeegee to man, they look nice. They look
Nice.
real nice. I'm not a big fan of doing my own kind of work around the house like that, but it was too nice
But
not
you-
to be outside.
You put that pole to work, didn't you?
You could say that.
Good for you.
Yeah. But yeah, man. We're all about ready to hibernate here before too long where
Yeah.
I live. But
Yeah, we put the boat to bed. That's, I guess, the one thing that we did. And then we just kind of chilled out a little bit. Drove some electric go-karts yesterday. That was fun. They were fast.
is it an indoor thing?
And yeah, indoor.
Yeah,
Pretty
we got one of
cool.
those around here. I haven't been in years, but that's fun.
Yeah, it was really
Yeah.
fun.
Yeah. Were they fast enough where they make you wear a helmet?
Oh yeah.
Yeah.
Oh yeah.
Yeah, that's
Helmet, full face. Oh yeah. So
I
it
remember
was
being
good.
in Texas for pilot training, and they had this junky go-kart track, and they were, motorized go-karts, fueled. And there was half the track wasn't even lit up, and it was nighttime. So it was almost pitch black going around half that track. And one of my buddies put me into the wall, and my go-kart flipped over. And I was like, I picked myself up off the gravel and like brushed myself off. And the owner drove up a new go-kart, and he's like, "Here you go, get in this one." So I jumped in and took off.
Awesome.
Like that just probably wouldn't happen these days in too many places anymore.
No. But we definitely crashed. I mean, it was crashing. I mean, it was NASCAR, not Formula One. It was awesome.
Yeah. That's fun.
If you're not rubbing, you're not racing.
If you ain't first, you're last.
That's right. If you're not first, you're last. So we got a couple of things we're going to talk about today, don't we?
Yeah. So I sent out an email this last week to all of my clients, I think last week, really showing a breakdown of all the paid up additions. If some of them had additional room in their policies for PUA, for paid up additions, then I let them know, hey, you have, some people had, $6,000, some people had 1,700, some people have 500, but this was all additional room inside their policies that they weren't planning on. That, hey, now here's an opportunity. You have this much room left. You can fund this before the end of your policy year. So here you go. And then showed them or explained to them how to search that on their own going forward every year.
Right.
So why would I do that? Why would I send that message out to my clients? What's the benefit of that? What would you say?
Well, for one, if there is additional paid up addition space and they have the capital to put into that rider, it's better to keep that money in their own policies, right? In their own banking system, quote banking system, than it is somewhere else. So,
Right.
Yeah, and it's going to adjust, especially in that first 7-year period. I think is another benefit. It's going to kind of adjust that kind of rolling average for that rider, so it'll adjust it upwards.
Yeah. And, if you have, and I think where a lot of people, I got a lot of email responses back like, hey, thanks, I'm going to fund this right away. What that means to me is, hey, you've got additional capital laying somewhere else right now, right? You got money sitting in somebody else's bank because maybe your first policy um
Yeah, it's too
wasn't big
small.
enough. Yeah, maybe it was too small, or maybe you've outgrown it, right? So you still use it and you still maximize it, but maybe this is a reminder for some people that, hey, if I've got extra capital laying around, that money has to reside somewhere. So maybe it's time to open a new branch of our family bank.
Yeah. It kind of reminds me of the discussion we had on one of the episodes, Dave, when I think we both had clients that they had outstanding policy loans, right? And they were like, but they had the money to pay it off somewhere else. And I was like, but it was like some of that money was premium dollars for next year's premium or something. And they're like, hey, and we told them, pay off that policy loan. This is going to make you as efficient as possible. So it's really the same thing. Put your money in your own banking system, whether that's via loan repayment or premium. And of course, you're only going to add to the capital base via premium, which is why this PUA strategy of finding that extra PUA that sometimes exists as they mech test the policy year to year. It's fantastic. Put it in there.
Yeah. Yeah. And the reason I had a bunch of people question, like, why do I have this? Why am I able to fund more? And I guess maybe the simplest way I can explain it is, like you said, the policies are mech tested. They're tested against the modified endowment contract limits every year by the company, because like we say, as soon as an illustration is printed, it's out of date.
Right.
Right. It's a best estimate that the company can provide at that time. In the next year, maybe the things perform differently. They most certainly will perform differently than they think, on one day. Throughout the rest of the year, things might change, which means they're testing your policies. They're mech testing them to say, hey, is this premium this person is going to pay this year, is that going to be too much for the policy and create a mech? And if so, we will limit the amount of premium they can pay. But sometimes it works out in your favor where, hey, they adjusted the mech line up, and now there's a gap there that you can fill with additional premium. But the thing is, insurance companies, in my experience, are not going to call you up or send you an email and say, hey, you have the opportunity to fund an extra $3,000 of paid up additions this year. Would you like to do that? They're not going to. Either your agent or you have to figure that out. So and every company works a little bit different.
That's right.
I know with some companies, you have the ability starting in year 2 or 3 to increase your PUA by 10% every year, but you have to do that before your anniversary date. So what you need to do is, it's going to require some effort, but if you want to be your own banker, you got to make the effort. Call the insurance company and say, how much additional paid up additions can I fund this policy year? And is there any way to increase that if you want to increase it? So it's kind of, taking responsibility. That's what I love about this concept, is people take full personal responsibility. They're not blaming their agent or the company for something that went wrong.
Nope. I'd like to teach you how to become your own banker, but I don't want to be your banker.
Right.
I want you to become your own banker.
Yeah. No, I'm happy to dig these numbers up for you if you're unable, or if you wait on hold for an hour and can't get through to the company to help you out. Send me an email and I can tell you how much more you can pay.
Yeah. And I've had several clients do that based on that episode a few weeks ago, and fantastic. Some people had significant premium they could pay. Some had a few dollars, but again, I think I said this last time, every little bit helps.
Every little bit helps, just like you said, especially in the early years, because that may determine how much you can pay in later years. So the more you can fund now, the better, because later on you want to be able to fund as many dollars as possible, because that policy is so incredibly efficient. I was looking at one today, a 37-year-old male. We were looking at a pretty high premium. But what happened when he hit retirement age, less than 30 years from now, at age 65, every dollar of premium he paid, according to the illustration, created $5 of cash value. Could you imagine getting a 500% return on your money during retirement and accessible tax-free.
It's almost like a smart person would want to put as much money into such a system as possible.
I'm telling you that just looking at that one motivated me to, all right, I need to create another significant policy, because once I hit retirement, I'll be able to live off dividends if I want, tax-free dividends coming in, and
That's right.
increase a pay raise every year in retirement at that.
Yep. But you wouldn't use dividends probably.
No, I'll probably let those continue purchasing more paid up additions just to maximize the growth and efficiency of my policy, and take loans as I want to, and spend as much as I want, and live the good life.
Yeah, me too. And I want to cover that in Nelson's book. Some people read Becoming Your Own Banker, Dave, and they think that, all right, that is the way he set those examples and those illustrations, whether it's CD sisters or equipment financing or whatever, is, that has to be the way. And of course, in that book, he didn't illustrate loans, although he has a caveat in there where he's like, hey, I would use loans, just so you know. I would not take dividends. I would not surrender paid up additions to do what I'm doing. I would use loans. And I've said that before in the podcast, folks, but it bears clarification, because people kind of take what he put in the book as kind of the gospel. And while the book is the gospel for IBC, it is not, those were just particular scenarios that he wanted to demonstrate that you could do such things. And of course, again, the other caveat is that book was written in 2000, and dividend scales have come down a bit, but it just takes longer to do what he illustrated.
Exactly.
But it can still be
says,
done.
Yeah. In the addendum, right after the equipment financing chapter, there is an addendum where on page 63, where really he goes into, look, when this book was written 20 years ago, dividend scales were different. If it took 4 years to get to a certain point, then maybe it'll take 7 years to get to that point now.
Right.
But the fact is, you're going to get to that point, which
Correct.
is why everybody should be involved in two businesses. The most important one being the business of banking, because it's guaranteed
business
to be successful.
Yeah. That's a great analogy too, right? This is a business. Your infinite banking style, dividend paying all life insurance policies, each one is a business, and it's a business that's guaranteed to succeed. And you have an entire administrative apparatus behind it, just making it work. All you have to do is provide the capital to it every year, and they'll do the rest.
That's true. That's all you have to do. So that's where your second business comes into play, the business where you make your money.
That's right.
Right? Use that, capitalize your banking business, and then at some point your banking business can take over. As long as you capitalize it enough, it can take over, and really, what businesses spawn from that. I like that equipment financing chapter starting on page 51. That's such you don't have to go out and finance trucking equipment. Like you and I financed a dump truck for a guy for his business, right?
That's right.
It's a very successful investment that we made, and very successful for him as well. So it was an absolute win-win. But I was talking to a guy who, before he even read this book, he was like, yeah, I've got a friend who owns a business and he needs some machinery. And I was thinking, I've got money sitting around. Maybe I can just buy it for him and lease it to him. And I was like, get this book and read page 51. Like, read that chapter. It will resonate to you. But that's like, banking is a business. When you have access to capital, you can brainstorm different types of businesses you want to be involved in. Everybody's probably got some family member or friend who owns a business and has to keep an inventory or keep some kind of equipment. What if you could be their bank? They could come to you for the loan. You could help their business and make money at the same time.
Yeah, exactly right. And better yet, teach them, give them Nelson's book to read.
Yeah. So they can start financing it with their own bank, instead of coming to you.
Yep. Build that 10%.
Yeah. So you said there was you were talking to somebody, I guess a pretty successful individual,
Yeah, he's a retired military officer, just like we will be at some point,
Yep.
and got into real estate syndication, I think, toward the end of his career. And we were chatting the other day, and he's a good dude. But he read the book, read Nelson's book a few years ago, I guess, and just couldn't. Probably needs to read it again. Probably, I think even Nelson, he said this takes several thorough readings, right? Then he says, if you don't get it after that, please, give me a call. But I think he's right. I think it does take several readings. I'm still picking things up when I pick the book up. So anyway, opportunity cost came up. He's like, I think I understand the infinite banking concept and how it works, but I just can't get past opportunity cost. And this is the trap, I think, Dave, that people fall into, where they're like, I can't do this and that. I can only do this. And I want to do this because I'm good at it. And that might be single family fix and flip, the BRRRR strategy, syndication. You're a truck, you own a dump truck business, whatever it is. In fact, the dump truck business, that's kind of how it went down, after the fact.
Yeah. Well, so
participate in
define
IBC,
opportunity cost as he was saying it, because you and I have a different definition of opportunity cost.
So he didn't. Well, I know we talked before we hit record. He didn't bring up like the startup cost aspect to it, where there's some delayed gratification, meaning every dollar that I paid in premium in the early years is not going to have an equivalent dollar of cash value that I can access. I think his was more extreme. Like I said at the beginning, it was more, I can't do both, or I'll be extremely limited in doing both things that I want to do. My business that I'm in and the infinite banking concept. And that's just it's really a misnomer, because you can do both, with the caveat that you are going to have a little bit of, you're going to sacrifice some liquidity in the early years. But there's policy design things that we could do, right, Dave, where we can really jumpstart the system using, special riders and stuff like that. So trust me, if you can think long range, like beyond tomorrow or next year, you can do IBC. Anybody can do it. And you had a good chat with somebody recently that had a good way to kind of talk about why it is better. It addresses opportunity cost. You're not sacrificing anything, especially in the long run. You will come out ahead, for sure.
Yeah, absolutely. I think, like you said, you got to think long term. Now, I'll speak directly to our real estate investors who are listening. A lot of real estate investors have difficulty thinking long term. I know, because I did that full time for a couple of years, but I flipped houses, right? And you kind of call yourself a real estate investor when you flip houses, because you're investing in real estate, but it's a very short term investment. Right. You're thinking, how can I maximize my profitability right now, be in and out in 90 days, cash out, and then move on? That's not a quick in and out mindset. Yeah. Yep. And so if that's your mindset, then of course you're thinking, I need access to 100% of every dollar I can possibly get my hands on right now, because I don't have the patience or the long-term mindset to make a sacrifice today, knowing that long-term this is going to pay off. Right. So it's, there is a sacrifice that comes to it. Some of that's delayed gratification. But again, going back to, if you can start a business that is going to be successful, guaranteed, how big of a business do you want to start? Just get over the hump, get past the first few years of not having access to everything you put in, and then it's going to start coming back to you. And then it'll come back to you in spades.
Yep. In fact, you won't even think about it. I have 7 of these policies that are designed for IBC, and I don't think about the liquidity, the sacrificing of a little bit of liquidity at all. It's not even something that ever pops into my mind. It just is. Yeah. I look down the road. I mean, even when I look at an illustration, what's this going to look like in 15, 20 years? Yeah. It's exciting to think about. Yeah. I mean, I just put a policy in on, one of the kids in my family for 100% base, no PUA at all. Yep. It was just strictly base, because for his situation, I thought that was going to be the best thing. So do I care how much
access to the liquidity I have right now? Not at all. I know it's coming back to me.
Right. And it's going to serve him well in the future too.
Yeah.
Maybe.
Yeah. So give us, try to explain opportunity cost in a different way. When you and I talk about opportunity costs, we talk the opportunity cost of paying cash predominantly.
That's right.
Right.
Yeah.
Here's another thing. If you don't have the patience to put your capital somewhere where it's going to compound on itself and you can leverage it, then you'll never be able to use your dollars in two places at one time.
That's right.
The only way to do that is to put it somewhere. You're going to have to sacrifice a little bit early on, but the only way to get your two uses out of every dollar is to do something like this. So, and then you recapture that opportunity cost of paying cash because you never give up the ability to earn interest on that cash for the rest of your life.
And maybe that's just a mechanical blockage, mental blockage, because they don't understand how a policy actually works, how it can actually be set up to be very liquid. Or, you've watched a lot of the wrong stuff on the interwebs, on YouTube especially, where there's just a lot of garbage out there.
Yeah.
And you got bad information. IBC addresses opportunity cost because, again, yes, you can leverage the cash value that's available and it still grows at the same time because you're not taking money from the policy. You're taking money against the policy and using the policy's cash value, really the death benefit, as collateral. And if you don't understand that, I don't know how else to, other than, we did a little, all right, so check this out, right? Pretend you're a pilot. You're an airline captain, first officer, or whatever, and you're flying along, and you're like, hey, Bob, I gotta go to the bathroom, maybe grab a snack, So you go do your thing, you grab some chips, you grab a water, whatever. More than likely someone brings it to you, but whatever, just stay with me.
Yeah.
You come back to the cockpit, and everything is better. You're closer to your destination. The aircraft is lighter, so it performs better. There's things that you can do in the airplane that you couldn't do, and maybe you were gone, and maybe you were in the bathroom for 20 minutes. You burned off umpteen, 100 gallons of fuel, right? I don't know what the burn rate is on some of those bigger jets. I know in the Apache, we burn about 1,000 pounds an hour. So, yeah, it's a lot. She's big. Anyway, so everything's better. You're more efficient. You're closer to your destination. And guess what? You were just using Bob, or he was more likely on autopilot. Things were just working as expected. And
yeah, and
that's
basically do two things at once. You could get up, go move around, go to the restroom, come back, and you're closer to your destination.
Yep, and you didn't do anything.
Yeah, right. Yeah, I think that's pretty good. That's about as good as an analogy as we can draw for opportunity cost. Because honestly, I can't think of anything else where you get to compound the use of something while using it at the same time. I was talking to a client and friend of mine and a pilot as well, Andy, recently, and I like the way he explained this. He's like, I get to use my money while it continues to compound in the background at the same time.
Yeah, I love it.
So just think of that. It's like your money is compounding over there in the background, yet you get to take it and use it right now at the same time.
I thought of something else that came up. So all these people got into real estate investing when interest rates were, Fed was at 0. You could borrow at 2 to 3%, and everyone was getting spoiled. You couldn't walk around the corner without running into somebody who's like, I'm investing in real estate, and it was good for them. It's awesome. I mean, we do it as well, and actively, passively, whatever. But anyway, I had to yell at the kids real quick. They're being awfully loud. Where was I?
Yeah, people investing in real estate, years ago because the rates were so low.
Right. So, we were spoiled the last few years with interest rates, and everyone's complaining because interest rates are high. So we got into the conversation about, I was like, hey, I can get to money at 5% without a repayment schedule. I set the, repayment terms. And it's more like like a line of credit, which, they're all familiar with, right? And I was like, what, can you get to money at 5% from any of these banks?
Yeah.
Not even close.
No. And they're like, oh, really? Can I get some of that? I'll be like, sure. 12%.
Yeah, you can.
Yeah.
And the other thing, when I especially think of like the syndication types, or even other folks, but syndication, they collect these giant acquisition fees, right? That can be, depending on the property, are quite enormous. And then, where does that money go? I mean, maybe you're living off it, maybe, but it should. I mean, I'm try to tell these guys, policies could be designed to accept those windfalls.
Yeah, you got to
keep them as liquid
that,
as
man.
possible.
If you could capture that, imagine being able to capture every acquisition fee you've acquired over your entire real estate career. If you're a syndicator, if you've been doing this for 10 years and you're going to do it for another 20, 30 years of acquisition fees, how much is that? What if you were able to capture that permanently and have that cash always working for you in the background while you're able to use it at the same time? Like that, how much wealth is that creating? And then on top of that, how much death benefit? Your biggest problem is going to be, who do I leave all this money to when I die?
Right.
That's going to be your biggest problem. And that could be a problem, but it's a different kind of problem that you'd be happy to have.
And a lot of them support, some charitable organizations. Like they'll cut off a piece of the deal for some sort of charity, whether it's, trafficking women or some other, Christian organization, whatever it is. So these people are charitable people, and they could do so much better by doing it this way. And that's not a bash on them at all. It's just, and we've talked about it with several of them over the years, and whatever. It's all good.
Yeah. But just got to have a little bit of patience.
That's right.
A little bit of patience goes a long way.
That's right.
Nothing great, was ever created overnight.
Yeah. Could have taken 7 nights.
Yeah.
Or 7 years.
Yeah, exactly. As Nelson says, 7 years. 7. Yeah, number comes up a lot. But yeah, nothing great is created overnight, immediately. Just like a success, an overnight success, there is no such thing. Anybody who was ever an overnight success became that because of all the years of work they put into it before anybody ever saw it.
Yeah, no question. And Nelson brings up that example in banks, in the banking example, right? To get the charter and get all the capital and, probably grease the skids with some bureaucrats, I'm sure. Yeah, it takes time, but it's worth it in the end, right? Couple of other podcasts I listened to, they were talking about the Rothschilds recently on a recent episode. Banking dynasty. Why did these people get into banking? And of course, they funded both sides of wars and stuff like that. Yeah, that's fine. Whatever. It's not.
Yeah,
it's not
because it's probably as close to playing God on earth as you can possibly get.
Correct. JP Morgan. All these families got into the banking business in finance. Yeah. Somebody financed that bank. Somebody financed that first. The capital that started it, right? They got into it for a reason, folks. So just bear with us. Do well at the business that you're in, but also be in the banking business. I can't put it any simpler than that.
No, I agree. And then be in the bank expansion business. So just keep those policies going. People are always surprised when I say I've got like 10 policies and I've got an 11th in underwriting right now.
Yep.
And talk to me this time next year. I'll probably have 12, 13, or 14.
Yeah. The assumption is that I can only own one life insurance policy on my own life. A lot of people don't even realize that you can own policies in other people's lives. I think they understand their children, but in spouse maybe, but not maybe business partners or people that might be in debt to you or, whatever it is. There's all kinds of business interests and insurable interests, that are insurable.
Right. If you don't think life insurance goes beyond just the individual, try to go get a small loan from a business loan from the SBA, Small Business Administration. They're going to require you have life insurance equivalent to that loan for the term of the loan. And they are going to be the beneficiary. That's how important. I mean, everybody knows that. All these institutions know how important life insurance is.
Yep.
Yet they don't really push it on us because, I think they have other avenues that where they get to control your money.
Oh, no question.
Yeah.
You know, and I didn't bring this up with him, but folks, you can go look up, bank-owned life insurance, corporate-owned life insurance, Boley and Coley. Banks and corporations buy life insurance products. They buy annuities. A lot of these big companies, they're parts of their pensions, the pension risk is transferred to life insurance companies with annuities.
And something I recently learned from somebody in the investment banking industry is that most transactions out there, most big financial transactions, are backed by some type of life insurance policy. Can you believe that?
It makes sense. Like, what did we think about when we did some private loans? It's one of the questions I would always ask, like, hey, do you have life insurance? Okay, great. Like, I would like to be made a beneficiary when this debt exists.
Right.
Like,
it's only fair.
And I do, irrevocable beneficiary. So that I have to sign off on changing it back. Anyway, little tip for you.
Yeah, I agree. So, well, all right. I think we covered enough. I think we got some other things and some notes that we'll tackle next week. But yeah, so hey, leave you with an action item. Call your insurance company, ask how much additional paid up additions or additional life insurance rider, whatever they call it, how much extra you can pay this year, and then max it out. Fully funded. It's going to benefit you with higher death benefit, higher cash value, and more growth, more access to capital.
Yeah, it's great tip, and something that I already talked about it last couple episodes ago, but I took advantage. It's great.
Yep, absolutely. All right, everybody. Well, we'll talk to you next week. Until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.